Hey everyone, welcome back. Today we're going to be tackling something that's probably on your mind a lot,
Yeah.
fundraising.
hmm
Especially for you building a tech startup, it can feel like the make or break hurdle.
For sure.
So to guide us through all of this, we've got our expert here ready to break down the insights from Raise Millions by Hustle Fund VC.
Happy to be here and happy to dive into this book. It's a gem.
And what I found refreshing is it doesn't just assume everyone should be chasing millions, you know?
Yeah.
It really makes you pause and think, is this the right path for me right now?
It's a point a lot of people miss in the rush to just scale.
Yeah.
The book really emphasizes those trade-offs. VC funding, sure, it can fuel rapid growth, but you're giving up a piece of your company, a piece of your control.
Right.
That's a big decision and not one to be taken lightly.
Okay, so let's break this down for our listener.
Okay.
Should you even be seeking funding right now?
Yeah.
What are some of those red flags the book raises? And when does it actually become the smart move?
Well, I think the core question here is, what is your vision for this company?
Okay.
If it's that classic high growth, aiming for a big exit, maybe even going public someday, then VC funding starts to make sense. It's like rocket fuel.
Right.
But if you're envisioning something maybe more stable, a profitable lifestyle business, bootstrapping or slower growth might be a better fit. You retain more control. You can build at your own pace.
I can totally relate to that. Early on, I had this idea for well, never mind the specifics.
Sure.
But I got so caught up in this fantasy of pitching it to VCs, getting millions, and then it hit me, I was more excited about creating something.
Right.
Not necessarily managing this like hyper-growth beast.
Yeah.
And this book really helps you figure out which path actually aligns with your goals, which is so valuable.
It's aligning that fundraising strategy with your personal definition of success.
I love that.
And Hustle Fund, they're VCs themselves, but they're very upfront about what they look for. They want to see solid unit economics. In other words, are you making more money per customer than it costs to actually get them?
That makes sense. It's got to be sustainable, not just a cash burn.
Exactly. And on top of that, can you acquire those customers at scale?
Okay.
Is there potential for exponential growth where the revenue is outpacing the cost significantly? If those pieces aren't in place, VC money might not be the right fit just yet.
So let's say our listener, they are aiming for that rocket ship growth. They've checked those boxes.
Okay.
The book goes beyond the simple, like, angels are small checks, VCs are big checks thing. It gets into the personalities involved, which I found fascinating.
Yeah, that's where it gets really interesting.
Okay.
Angels are individuals, often driven by their own experiences and passions.
Right.
They can move faster, the decisions are more personal, it's not a committee.
Yeah.
Plus, they might be extremely hands-on, especially if they've built successful companies themselves.
Okay.
Imagine having an angel who helped build, a huge e-commerce brand, now guiding your online store strategy.
Yeah.
That's mentorship gold.
It's not just about the money. It's about the potential partnership, the guidance they can bring.
Absolutely.
The book even gives examples of angels helping refine product roadmaps, making key customer introductions.
Totally.
What stands out to you, listener, thinking about what you're building? Could you see the value of that kind of angel in your corner?
Yeah, I think it's a huge plus.
Yeah.
Now, VCs operate differently. They're managing other people's money, so the bar for return on investment is naturally higher.
Right.
They need to see that massive growth potential.
Yeah.
But what they bring to the table is access to huge networks, connections to future funding rounds, potentially more resources down the line. It's a different kind of support system.
And speaking of setting yourself up for success down the line, I have to share this anecdote. Hustle Fund's Eric Bond, he made this mistake early on, didn't incorporate in Delaware, cost him big time on taxes later. It's a cautionary tale the book uses to highlight why certain legal decisions matter way before you're like some massive company.
Makes sense, yeah.
Like, you got to think ahead.
Early choices can have big consequences.
Exactly.
So the book hammers home these 3 key benefits of a Delaware C Corp, and they're worth paying attention to early on.
Okay, I'm all ears. Taxes are my least favorite subject. But this book somehow made them almost interesting.
That's impressive, right?
I know.
All right, so first off, Delaware is famously business-friendly.
Oh, okay.
The laws and regulations are designed to support companies, not bog them down in red tape.
Less headache for founders, more focus on growth.
Exactly.
Okay, that's good. Less headache is always a win. But what about those tax savings?
Okay, yeah.
Eric's story made me a little nervous.
I understand that, so here's where it gets interesting.
Okay.
Delaware C Corp have access to something called QSBS.
What is that?
Qualified Small Business Stock.
Oh my goodness.
Sounds complicated, but the gist is, if you hold your company for over 5 years before selling it, you could be exempt from federal taxes on a huge chunk of that exit.
Wait, exempt?
Exempt.
Okay, now you've got my attention, listener. You taking notes? This is big.
It is, yeah.
Suddenly incorporating properly isn't just this legal formality. It's about potentially keeping a massive amount of your hard-earned success.
Powerful incentive, and the book doesn't shy away from spelling out those financial implications.
Yeah.
And the third benefit ties back to investors.
Okay.
They simply prefer Delaware C Corp.
Okay.
It makes things smoother down the line if you raise more funds, and it signals that you're serious about the long game.
So it's like a stamp of approval in a way.
It is, yeah.
You're playing in the big leagues now.
Exactly.
The book has this great tip. If you haven't incorporated yet, switching is relatively easy.
Yeah.
So, listener, no excuses. Get this right from the start.
For sure.
Okay, now for the part that everyone seems to stress about, equity dilution. How much of your company are you actually giving away when you raise funds?
Yeah.
The book uses this brilliant pizza analogy to explain it.
The pizza analogy.
It just makes it click instantly.
It's so visual.
Okay, so imagine your company is a delicious pizza.
Okay.
Each slice represents a percentage of ownership.
Perfect, yes.
In the beginning, you and your co-founders, you own the whole pie.
You got it.
100% deliciousness, all yours.
All yours.
But then you start raising money.
And you got to give away slices.
Uh-oh.
To investors, to advisors, maybe key employees. That's equity.
Hey.
They own a piece of the pie, which translates to real money if and when the company is sold or goes public.
Right.
And the book really stresses that dilution is inevitable.
Okay.
The question is, how do you do it smartly?
That's where things can get tricky.
Yes.
And I have to say, this book explained safes, simple agreements for future equity better than anything else I've read.
Oh, glad to hear that.
It was like, finally the light bulb went off.
Sometimes it just takes the right analogy.
Yeah.
So what's crucial here is grasping that difference between pre-money and post-money safes.
Okay, break that down for me.
All right, so pre-money is like giving someone a pizza ticket.
The pizza stick,
Yeah, to be redeemed for a slice later.
Oh, okay.
When the valuation is actually set.
Yeah.
But you don't know exactly how big that slice will be.
That's a little scary.
Yeah, and the book highlights a potential pitfall here.
Okay.
Founders can end up with a tiny sliver left if they're not careful with pre-money safes.
Ooh, I don't like that.
It's a cautionary tale.
I actually felt a little anxious reading that. Like all of a sudden the pizza's gone and you're left with crumbs.
Yeah, not exactly the founder's dream.
Not the dream.
That's why post-money safes are often preferred, especially by Hustle Fund.
Okay.
It's cleaner. It's like saying, this investment gets you this percentage of the pizza right now.
I like that. It's straightforward.
Transparent. Everyone knows where they stand. The book gives some simple examples, like raising $500,000 on a $5 million valuation equals 10% equity sold.
Easy math.
No mystery, which is good for both sides.
Yeah, takes away that fear factor.
For sure.
And the book mentions that typically you're aiming for 10 to 20% dilution per round, with the goal of founders keeping over 50% ownership after Series A.
That's a good target to keep in mind.
Yeah, makes you think long-term about how much you're willing to give up to fuel that growth.
It's a balancing act.
It is.
And that brings us to valuation, which is something everyone gets hung up on.
Oh, yeah.
The book's approach really helped me see it differently.
Okay.
It's less about what your company is worth on paper right now.
Okay.
And more about investor demand.
Break that down for me, because it seems kind of counterintuitive. Like, isn't my company worth what it's worth? How does demand play into it?
Well, especially in those early stages, it's more nuanced than just a fixed number.
Okay.
Think of it like this. Imagine you want to raise, say, $200,000 at a $1 million valuation.
Okay.
But suddenly you've got investors throwing $500,000 at you. That demand means you have leverage. You can likely increase the valuation because investors are eager to get a piece.
That's a good problem to have.
It is, yeah.
But on the flip side, if you're asking for, say, $2 million at a $5 million valuation, and no one's biting,
well, then your valuation is effectively zero.
ouch, that's a reality check.
Because no one's buying what you're selling.
So it's less about what we think we're worth and more about what the market, the investors, are actually willing to pay.
Especially in those early rounds.
Okay.
Now, pre-money and post-money valuations can get a bit technical,
Right.
but the core concept is this. Pre-money is your worth before the investment. Post-money is, well, after.
Okay.
The takeaway is, ideally, your valuation should increase over time as you grow, showing investors that you're building something truly valuable.
So higher valuation is always a good thing, right? More pizza slices for everyone.
Not necessarily. The book dives into the psychology here, which I found really insightful.
Oh, now this is where it gets interesting. Tell me more.
Think about it from the investor's perspective.
Okay.
They're looking for the biggest potential return, right? If they own a tiny sliver of your company because the valuation was sky high from the get-go,
Yeah.
they might not be as motivated to help you succeed
That's a good point.
compared to another startup where they have a larger stake.
Yeah, so it's not just about the money they put in.
Right.
It's about their level of commitment, wanting them to be truly invested in your success.
Exactly. And you need time to grow into that valuation.
Mm-hmm.
If you raise at, say, 12 million pre-seed based on hype, but then you struggle to gain traction,
Right.
raising the next round can be a nightmare. Investors want to see that upward trajectory,
So a flat or down round can be a red flag.
even in today's market.
Okay.
So it's about finding that sweet spot,
Mm-hmm.
a valuation that excites investors but also gives you room to grow without the pressure of unrealistic expectations.
Right, because you don't want to set yourself up for failure right out of the gate.
Exactly.
And the book also touches on how this impacts recruiting.
Oh, yeah.
If you're offering equity to early employees, a crazy high valuation means their shares might not be worth as much later on if you don't meet those lofty goals.
Right.
So you want to attract top talent with the potential for real upside, and a balanced valuation helps with that.
Absolutely. It's all connected.
It is. Okay, so we've covered a lot of the mechanics of fundraising,
Yeah.
but I have to admit, I'm someone who really struggles with the whole networking thing,
Okay.
and the book's approach to building relationships really resonated with me.
Yeah, it's less about those awkward networking events and more about genuine connection.
Right, and I think we all crave that, whether we're founders or investors.
Absolutely.
I used to force myself to be this networking guru, going to every event, collecting business cards.
Yeah.
It felt so inauthentic.
It can be. Yeah.
But the book emphasizes that people invest in people they like and trust.
That's the key.
It's about building real relationships, not just transactions.
Friendship first approach, and it makes so much sense when you think about it.
I know.
Consider your most helpful business contacts right now. I bet they're people you genuinely enjoy being around, sharing ideas with.
Absolutely. My best collaborations have come from people that I actually enjoy spending time with.
There you go.
Just makes the work so much more enjoyable, and you get better results.
Exactly. And the book suggests that's where you should start looking for investors.
Okay.
Your existing network, friends, family, colleagues.
Mm-hmm.
You never know who might be connected to an angel investor or even be one themselves.
Right.
The book even mentions Elizabeth Yin from Hustle Fund.
Yeah.
Pitched her optometrist.
See, everyone's a potential investor.
There you go.
But what if you need to go beyond that immediate circle?
Okay.
Any tips for finding investors in the wild, so to speak?
Online platforms like AngelList are great for targeting investors who've backed companies similar to yours.
Okay.
Twitter can be surprisingly effective if you engage thoughtfully.
Don't just spam your pitch.
No spamming, no.
Yeah.
And LinkedIn is a goldmine for warm intros. Asking someone you know to connect you to someone in their network who invests.
Oh, I like that. It's like leveraging those existing connections,
Exactly.
making those introductions meaningful. And I love the story about Hustle Fund's early days.
Yeah.
They were struggling to raise money, so what do? They threw a party.
Of course they did.
Not just any party, a taco party.
I love it.
Invited their existing investors, asked them to bring someone who might be interested in the fund.
Smart.
And guess what? It worked.
It makes sense. Created this relaxed, fun environment for connections to happen organically.
Love that.
Sometimes that's all it takes.
So listener, are you suddenly craving tacos and investor meetings?
Yeah.
But in all seriousness, the book emphasizes that sometimes the best approach is this mix of old school and new school.
Right.
Attend relevant conferences, get out there and meet people face to face.
Mm-hmm.
You never know what might spark a valuable connection.
Sometimes the best connections happen when you least expect them. But it's about creating those opportunities, putting yourself out there, and being open to building relationships that could lead to something great.
I love that. That's a great note to end this first part of our deep dive on.
I agree. And we're back, diving deeper into Raise Millions with you.
We were just talking about the importance of building those genuine relationships with investors, which can feel a bit different in this world of like pitch decks and valuations and all that.
For sure.
Speaking of pitch decks, I think this is where a lot of founders get tripped up.
Yeah.
The book does a great job of breaking down what investors are actually looking for.
Clarity, conciseness, really cutting through the noise.
Okay.
Forget those, like 20-slide monstrosities packed with jargon.
Yeah.
Hustle Fund recommends a tight 5 to 10 slides hitting the key points that really grab an investor's attention and make them want to learn more.
So give me those essential slides. What makes a pitch deck sing?
All right, first up, your team. Especially in those early stages, investors are betting on people as much as the idea itself.
Right.
They want to see relevant skills, experience, and that, fire in your belly for the problem you're tackling.
It's that founder market fit the book talks about.
Exactly.
Why are you the right person to solve this particular problem?
Right.
What's your unfair advantage?
Exactly. And showing that you and your co-founders have a strong working relationship.
Yeah.
Have you collaborated before, shipped a product together, weathered storms as a team? Investors want to see you can handle those inevitable challenges of building a startup.
It's not a solo sport.
I know. It's a team effort.
There's a reason they say, if you want to go fast, go alone. If you want to go far, go together.
Love that.
Startups are definitely a marathon, not a sprint. So having that right team in place can make or break you.
Couldn't agree more.
Okay, so we've got the team slide down.
Now, after that team slide, you've got to clearly articulate the problem you're solving.
Okay.
And this is where a lot of founders stumble. They get so excited about their solution that they forget to really lay out the why.
It's easy to get lost in the weeds when you're so close to the product, living and breathing it every day.
Absolutely. Investors need to be convinced this is a problem worth solving, one that people are actually willing to pay for a solution to.
Right.
It needs to be a big enough problem to justify their investment.
Yeah.
We're not talking about fixing small inconveniences here. We're talking about addressing a real need in the market.
So maybe less solving world hunger in our pitch decks. Back to reality a bit.
Well, world hunger's a valid problem, but investors want to see that sweet spot where impact meets feasibility.
Okay.
The book encourages founders to demonstrate they've done their homework. Have you talked to potential customers? Surveyed the market? Can you quantify the problem with data, not just assumptions?
Show, don't tell. I like it.
Yeah.
It's like storytelling, but with numbers backing it up.
Exactly.
Okay, so we've got the team. We've nailed the problem.
All right.
Now we get to the solution.
Okay, the fun part.
This is where we get to brag about how brilliant we are, right?
Well, there's a balance. The solution slide needs to be clear and concise, but it's also about differentiation.
Oh, yeah.
What makes your approach unique? Remember, investors are seeing dozens, maybe even hundreds of pitches a week.
It's a lot.
You have to stand out from the crowd.
It's not enough to just be better or faster or cheaper.
Right.
It's got to be that special sauce, that secret ingredient that makes investors go, I haven't seen that before. Tell me more.
Exactly. And the book highlights how to frame your story, especially if you're in an industry that investors might typically shy away from.
Ooh, okay.
For instance, let's say you're building a media company.
Okay.
Media companies aren't exactly known for generating those, massive returns VCs are looking for, right?
Not traditionally, no.
But the book gives this example of reframing a media company as a data company.
Oh, interesting.
Imagine you're building a community platform for teachers. You're collecting valuable information about their needs and preferences. Suddenly, it's not just about content creation. It's about the insights that data can provide, the potential for personalization, for targeted solutions.
And investors love data.
They do. It's like the new gold rush.
It's like finding that hidden gem in your business model, that angle that really sparks investor excitement. And even if your product is still early stage, the book encourages you to sell the vision.
Yes.
Where are you headed in the next 6 to 12 months? What are those key milestones you're aiming for?
Right.
Investors want to see you have a clear roadmap, that you're thinking big and moving fast.
It's about painting a picture of the future.
Yeah.
Showing that you're not just building a product, you're building a company with a clear trajectory.
So it's okay if the product isn't perfect yet,
Right.
as long as the vision is compelling, as long as you can articulate where you're going.
Investors are buying into that potential, not just what exists right now.
They're investing in the future you're building.
Exactly.
Okay, so after you lay out your solution, you need a strong market slide.
Oh, yeah.
And this is where things get real. especially if you're seeking VC funding.
They're looking for those billion-dollar markets, those potential rocket ships we talked about earlier.
Exactly. Hustle Fund's mantra is 100x outcome.
Oh, wow.
They're looking for investments that have the potential to return 100 times their initial investment.
That's a big number.
It is.
To achieve that kind of growth, you need a massive market opportunity.
Okay, so if my target market is just my grandma and her knitting circle,
It might not be the right fit.
maybe VC isn't the right fit, but if I'm disrupting the global sock industry, game on.
It's all about scale and potential.
Okay.
The book encourages founders to think about expansion markets.
Okay.
Maybe you start with a niche audience, but how can you grow that into something much larger?
Okay.
Look at HubSpot, for example.
Okay.
Started with marketing automation for small businesses, and now they're this massive enterprise software
Yeah,
company.
he started with a slice and ended up with the whole pizza.
Exactly. Show that potential for expansion, for capturing a bigger and bigger slice of that market pie.
Okay.
Investors want to see that path to exponential growth.
Makes sense.
Now, finally, we get to traction.
Okay, the proof is in the pudding.
Right. And if you're super early stage, you might not have a ton of data yet.
Right.
But even then, showing something is better than nothing.
Yeah, a blank slide isn't very compelling.
It's not, but maybe you have early users.
Okay.
Even if it's just friends and family providing feedback.
Yeah.
Or you've run some small marketing experiments, tested different acquisition channels, gathered some preliminary data.
Right.
The book emphasizes investors want to see progress.
Mm-hmm.
They want to know that you're not just sitting around waiting for funding to magically make things happen.
So even small wins count.
Absolutely.
It's about showing that we're hustling, learning, iterating, and moving the needle forward, even if it's just a little bit at first.
That's the key.
And if you do have some impressive numbers,
Yeah.
don't be shy about showcasing them.
Absolutely not. Revenue growth, customer acquisition costs, user retention rates.
Okay.
Quantify those successes and show how this funding will fuel even more growth and impact.
Okay, so we've got those 5 essential slides down.
Mhm.
Team, problem, solution, market, and traction.
You got it.
Anything else we should keep in mind when crafting our killer pitch deck?
Well, the book really stresses conciseness.
Okay.
Remember, the goal of the deck is to get a meeting, not to close the deal on the spot.
Yeah.
Don't overload it with information. Just highlight those key points that spark curiosity and leave investors wanting more.
Less is more. Make them hungry for the main course, so to speak.
Exactly. And don't underestimate the power of good design.
Yeah.
Hustle Fund actually collaborated with a company called Deck Doctors to create an entire ebook on pitch deck design.
Oh, cool.
We'll link to that in the show notes because it's packed with visual storytelling tips.
It's a great resource.
It's amazing how much design can impact the way your message is received.
For sure. Okay, so we've got our pitch deck polished.
Now, how do we actually get in front of investors? Those face-to-face or, these days, Zoom-to-Zoom encounters.
Well, this is where all that relationship building we talked about earlier comes into play.
Right. It's about nurturing those connections before you need them, not just reaching out when you're, desperate for funding.
Think of it like dating. You wouldn't propose on a first date, right?
Unless it was a really good taco date, but I get your point.
You want to get to know each other first, build rapport, see if there's mutual interest and alignment.
Okay.
The book suggests start with your existing network, ask friends, colleagues, even that optometrist you mentioned earlier.
Right.
If they know any investors, have connections to the VC world, you never know who might be able to make a valuable introduction.
You never know who has a secret angel investor in their contacts list.
Exactly. And
Yeah.
don't underestimate the power of online platforms, LinkedIn, AngelList.
Mm-hmm.
It's not about spamming people. It's about being strategic.
Research investors who've backed companies similar to yours. Engage with them thoughtfully online.
Okay.
See if you can build a genuine connection.
It's like building a dating profile for your startup.
I love that.
Highlight your best qualities, showcase your vision, but most importantly, be authentic. Be yourself.
Great analogy. And sometimes those chance encounters can lead to amazing opportunities.
Okay?
Attending relevant conferences and events can be valuable not just for the presentations, but for the networking. You never know who you might bump into at the coffee break.
Or at the taco truck outside the venue.
Exactly.
Speaking of which, remember Hustle Fund's taco party. Sometimes creating your own event, something fun and casual, can be the most effective way to connect with investors and build those relationships organically.
It's about creating an environment where people can connect on a human level, where those sparks of shared interest and excitement can ignite.
Welcome back to the final part of our deep dive into Raise Millions.
It's been a whirlwind, right?
It really has. Packed with insight so far.
Yeah.
From the nuts and bolts of valuations to, like, the art of crafting a killer pitch, building those all-important investor relationships.
Yeah, it's a journey.
It really is.
And it doesn't end when you get that yes from an investor.
Right.
In fact, you could argue that's just the beginning.
I can already feel the excitement, but also a bit of nerves thinking about what comes next.
Sure.
And where do we go from here?
One of the most important points the book stresses is the importance of doing your own due diligence on investors.
Okay.
It's a partnership, and it could last for years. You want to make sure you're not just taking money from anyone.
Right.
You're bringing on someone who's truly going to be a valuable addition to your journey.
It really is like dating, but with much higher stakes.
Yeah, the stakes are higher.
We're not just looking for a quick fling. We're looking for a committed partner.
Exactly.
Someone who's in it for the long haul, through those ups and downs.
Right. The book recommends talking to other founders who have worked with this investor.
Yeah.
Ask for references, reach out to those people, and get a sense of what it's really like to have them on your cap table.
So what kinds of questions should we be asking those founders?
Yeah.
Besides the obvious, like, are they a nightmare to work with?
Yeah, I think it's valuable to find out their level of involvement.
Okay.
Are they hands-on, offering guidance and support? Or are they more passive, just checking in occasionally to see how things are going?
It's about finding that balance, right?
Right.
We want someone who's engaged and invested in our success,
Yeah.
but also trusts us to run the company, not someone who's like micromanaging every decision.
Exactly. You want a partner, not a backseat driver.
I like that.
And it's also a good idea to ask about their communication style.
Oh,
Are they responsive to emails and calls? Do they provide clear and timely updates? Or do they leave you hanging wondering what's going on?
communication is so crucial in any relationship, but especially in the fast-paced world of startups where things are constantly changing. We need investors who are open, transparent, and proactive in keeping us informed.
It just builds trust and makes for a much smoother working relationship.
It does.
And don't hesitate to ask about their track record.
Okay.
Have they helped other founders achieve successful exits? Do they have a deep understanding of your industry, or are they just throwing money around hoping something sticks?
Yeah, we're not just looking for a check. We're looking for expertise, for guidance, for connections that can help us take our company to the next level.
Right. You want partners who can help you win.
Exactly. It's about finding investors who are aligned with your vision, who can bring more to the table than just capital.
For sure.
Okay, so let's say we've done our due diligence, we've talked to other founders, and we're feeling confident that this investor is a good fit.
Okay.
What happens next? Do we just send over our bank account details and wait for the millions to roll in?
Hold your horses. VCs have a process.
Okay.
The whole set of steps they need to take before they can actually wire you the money. They'll need to verify legal documents, things like your incorporation papers, your bylaws, maybe even your cap table.
Right, this is definitely where a good lawyer is worth their weight in gold.
Absolutely. Legal documents are not something you want to be messing around with without expert help.
Not at all.
So besides the legal stuff, what else should we be prepared for? Well, don't be surprised if they run a background check on you. It's standard procedure, just to make sure there are no skeletons in the closet.
My record is squeaky clean. Anything else?
You'll likely be asked to sign what's called a side letter.
A side letter.
It basically outlines additional rights the investor might have, things like pro rata rights, which means they get to invest in future rounds to maintain their ownership percentage, or most favored nation rights, which protect them if a later investor gets a better deal.
Okay.
It's all pretty standard stuff, but it's always a good idea to have your lawyer review everything carefully before you sign anything.
Okay, I'm starting to feel like I need a legal dictionary just to follow along.
Well, that's what lawyers are for.
That's true.
They'll guide you through the process and make sure everything is in order.
Yeah.
The book mentions once the legal and administrative stuff is sorted, you'll probably have to actually call the VC
Okay.
to confirm the wire transfer details. It's all about security, making sure everything's legitimate, preventing fraud.
So no texting my banking info to a random investor.
Probably not a good idea.
Noted.
Is there anything else we should watch out for? Any red flags? The book mentions a situation that's not necessarily malicious, but it can be a bit tricky.
Okay.
Sometimes VCs might commit to investing, but they don't actually have the money on hand yet.
Oh.
They might be in the process of raising their own fund, so their commitment to you is contingent on them getting funding first.
Oh, wow.
It can cause delays and uncertainty, so it's good to clarify that up front.
So it's okay to ask, hey, do you actually have the funds to back up this commitment right now?
Absolutely. It's a perfectly reasonable question.
Okay, good to know.
Okay, so let's fast forward. We've received the funds. All the paperwork is signed. Everything's legal and official.
Time to pop the champagne.
Well, almost.
Okay.
The book emphasizes this is a crucial moment to communicate clearly with your team.
Okay.
What are you going to do with this money? How does it affect your runway? The timeline for your next fundraise. Transparency builds trust and helps everyone stay focused on those shared goals.
So no surprise, spending sprees. No hiring a mariachi band to announce the good news.
Maybe save those celebrations for when you hit your milestones.
Okay, that's probably wise.
The book wisely reminds founders to let their teams know that funding isn't a guarantee of future success.
Right, it's not a magic bullet.
It's fuel to get you to the next level, but the hard work isn't over.
Yeah, you got to stay scrappy, stay focused, don't lose that startup hustle.
Exactly. It's easy to get caught up in the excitement, but it's important to stay grounded to remember fundraising is a means to an end, not the end goal itself.
It's a stepping stone.
It is. There's one final thought from the book that I found really powerful.
Okay, I'm all ears.
How you do anything is how you do everything.
Ooh, that's good. Break that down for me.
If you approach your fundraising process in an organized, diligent, and professional way, it sends a signal.
Okay.
It suggests that you'll bring that same level of care and attention to detail to building your company.
Right.
Investors are looking for those signals, those subtle cues that suggest you're someone they can trust, someone who will be a good steward of their capital.
It's about building a reputation for excellence, not just in your product or service, but in every aspect of your business.
Yeah, exactly.
And that extends to how you handle fundraising, how you treat investors, how you communicate with your team.
Precisely. It's about integrity, it's about building trust, and it's about demonstrating that you're in it for the long game.
Wow, we've covered a lot of ground in this deep dive into Raise Millions.
They have.
It's been packed with insights and actionable advice for anyone navigating the world of fundraising.
Yeah, I think the key takeaway is it's not just about the money. It's about finding the right partners, building those strong relationships, and approaching every step of the process with integrity and a clear vision for the future.
I hope you, listener, are feeling more equipped to tackle this fundraising beast, to find those partners who are as passionate about your vision as you are, and to build the company of your dreams.
That's the goal.
It is. And if any of this resonated with you, I highly recommend checking out Raise Millions by Hustle Fund VC.
Great book.
We'll link to it in the show notes, along with all those other great resources that we mentioned.
Awesome.
And as always, we love hearing from you.
Yeah.
Reach out with your questions, your takeaways, your fundraising wins and challenges. Until next time, happy hustling.
Happy hustling.